So I need money, that's why I wrote an algorithm and taught it how to make. It appears to be getting harder and harder to find extra profits in the markets. There are still fortunes to be made with a bit of human ingenuity and technical prowess. We will use this algorithm to capture one of the few remaining arbitrage strategies, volatility. Volatility arbitrage isn't as intimidating as it appears at first, so let's explore why it isn't as hard as you may think. Volatility arbitrage. It is important to understand the relationship between option prices, Greeks, and volatility before you can understand volatility arbitrage. Delta and implied volatility, 4, are the two concepts to master. Implied volatility. From now on, we will refer to implied volatility as 4. The market forecasts the price movement of a security over the life of an option. The market forecasts the price of an option by 90% by the time it expires, so if the 4 of an option is 90%, it means that the price will increase or decrease by 90% by the expiration date. An investor must pay a higher premium when the 4 is high. As option writers must be compensated for their risks, so does their compensation need to increase. Delta. The delta is just one component of the many options Greeks, but it is the most straightforward and useful. Delta is the difference between the option price and the stock price per change of $1. When the stock moves by $1, an option with a delta of 56 increases or decreases by $56. A call option's delta ranges from 0 to 1, while a put option's delta ranges from 0 to -1. There will be a need for this in the future. Delta hedging. Arbitrage in this trade occurs as a result of the difference between implied volatility, 4, and realized volatility, RV. The trader's profit is the 5% difference between an option with a 95% 4 and one that only moved by 90% by expiration. Delta hedging allows the profit to be realized simultaneously. Another simple concept is delta hedging. In order to create a market-neutral position, a trader would short 56 shares of the underlying stock with a delta of 56, so that changes in the underlying would have an inverse effect on the call option. Trading delta-neutral positions until expiration allow the trader to earn the 5% premium mentioned above. The algorithm. Despite your excitement about testing this newfound theory, there is one problem. RV, realized volatility, should be estimated correctly. It's a mouthful, but GRCH models are currently the best method of estimating volatility. The good news is that Python allows you to take full advantage of these models without having a PhD from the University of Douchebags in math. To begin, let's estimate realized volatility below. First, let's import everything. Now I am going to fit and train our data. You will see a decimal value for what your chosen securities for will be based on the volatility prediction above. For June 2020, I chose this method because you can independently verify its accuracy. The RV estimate was 122% for 2020-06-11. To secure your profit, short an in-the-money call option within 4 greater than 122%, delta hedge the shares simultaneously, and wait until expiration.